M&A volumes of this magnitude are unusual at this stage of the business cycle. Many of the drivers do look set to continue, though leadership may be about to shift.
M&A has had its strongest period since record began, and in the last quarter we've seen deal values over $1.5 trillion, and it's in fact the fourth consecutive quarter where we've topped $1 trillion, which is really quite astounding. So the recovery that we saw last year is continuing ahead full steam. M&A is largely a confidence game, and the removal of many of the factors that created a lot of uncertainty, presidential elections in the US, as well as the pandemic crisis, has resulted in an environment where deal makers are largely much more comfortable pursuing the M&A agenda again. Capital markets are very strong. Interest rate environment continues to be favorable. Private equity is a very big driver for deal activity, and to some extent SPACs as well. So what we're really looking at here is a situation where we are likely to continue to see elevated deal activity going into the second half of the year. Private equity or financial sponsor-backed M&A activity continues to really drive the numbers up here. So we saw about $500 billion worth of deal activity in the latest period. And the markets have been very favorable for private equity. The private equity continues to raise record amounts of capital from limited partners, meaning that they continue to drive deals in the next half of the year. But what I'm going to predict, which is perhaps a little bit against the grain here, is that we are going to enter an environment where private equity will find itself increasingly squeezed. So as corporate deal makers are getting more comfortable with the M&A agenda again, and they're really going to enter the fray here, we're going to see a situation where prices are pushed up. We're already seeing an increase in valuations where EBITDA multiples of deals is approaching 17x, which is a steady upwards trajectory. And what will happen here is as corporates continue to pay a premium for assets, private equity will increasingly get squeezed. Obviously, we talked a lot about SPACs during the last year. So special purpose acquisition companies are obviously the blank check vehicles that take private companies public through a reverse merger. Now, these vehicles obviously have a lot of criticism in terms of higher risk and some uncertainty, lack of transparency, so on, but also a lot of proponents. And while SPAC activity has dropped off a little in the latest quarter, it's down to 14% now. 14% of deal activity is still a very significant part. And interestingly, we are starting to see SPACs looking at cross-border transactions. So expanding outside the US, which was the original home of the SPAC, so to speak, and now looking increasingly at international targets. So technology M&A continues to be the highest sector here. So we see an awful lot of activity in technology, both in high tech and other technology sectors. We also see a lot of activity in financial services as well as energy and power. Now, what's really interesting, and what I think will continue to drive technology as our top sector going forward, is the fact that this is expanding beyond our high-tech firms, right? So we're now also seeing a lot of tech M&A activity from more traditional businesses. And the reason for this is that traditional firms, whether they are industrial or perhaps retail or other types of services, they are under pressure to innovate, right? And what this really means is increasingly to go digital. We're in an environment where there are very high expectations, both in terms of growth and returns from investors. So just taking a look at the equity markets will tell you this, right? They're trading very highly. So companies therefore are under pressure to meet these return expectations from investors, and M&A often becomes a good solution to achieve those return targets. And with that background, I'm sure that we're going to continue to see a lot of M&A activity as companies continue to expand their businesses and to meet those return expectations from investors. In the second half of the year, we're going to continue to see record M&A as well as capital markets activity.
If leadership in the M&A space shifts to corporates, we may well see another burst of activity from private equity before valuations get really out of reach. The size of these war chests suggests that global equity should reap the rewards for at least the rest of this year.